And the old saying goes that the bond market is smarter than the equities market. So which one's got it right when it comes to pricing recession risk?
Well, we try to compare different asset classes and see where different probability lies. I think over the course of this year so far, there has been more pricing of a soft landing scenario. We have seen very mixed signals coming through from hard and soft data in the U.S. in particular, and you have seen Treasury yields coming down to reflect perhaps a bit more of that recession risk ahead, driven by some of the large increases in Fed funds rate last year, and then the lagged impact to the real economy down the line. But equity seems to be cheering it with slightly up, at least in the U.S. market and more in Asia market so far.
Well, we are seeing a lot of volatility in markets at the moment. How are you making decisions around duration right now?
I think overall we see duration as less directional this year. Last year we have seen a very big adjustment from different central banks, and the pricing of particularly the front end of yield curve has been extremely volatile. Now looking forward, central banks are expected to potentially hike a couple more times perhaps and then pause from there. But the extent of the forecast are now closer to in terms of between different players. So all in, we think the volatility of the bond market, most notably in the risk-free rates and the treasury yields, are going to come down from there. And we think the way we would play it is to look at 10-year to be within a range, and some of the instrument that might capture a lower volatility, such as mortgage-backed securities, can perform quite well.
We have seen this rally being led by soft landing bulls. We recently had a Bloomberg opinion columnist just argue that perhaps we need to see a bad earnings season to sort of reset expectations that would be easier to beat and actually set the fundamentals for a really sustainable bull market. What do you think?
I think for now, the Fed has talked still quite hawkishly. They would be looking at the financial condition index, and there are different variations of that, which might include equities, look at credit spreads, maybe even a dollar level. And if that were to ease too quickly, I think that Fed will stay hawkish longer and may potentially extend out some of the worry, given that the bond market is kind of where a lot of the discount rate get derived from. And if it comes down, then it could be positive for some of the risk market. But if it stay up, then I think that could remain challenging for what we call outer perimeter assets. That includes equities and just generally higher, high yielding, lower quality instruments.
So if we do see things go the way they're going right now and perhaps a pivot sooner than expected, does that mean weakness for the U.S. dollar, and where does that leave Asian currencies?
We actually like Asian currencies, with particular China reopening faster. I think there will be some upside to growth forecasts for China, which also have implication for the rest of Asia, including many of these tourist kind of beneficial countries. So from our standpoint, some of the currencies we like include the Thai baht, includes the Indonesian rupiah, and China. We also have small overweight in the currency as well. So I think that is probably what's going to help drive a little bit more of the difference between perhaps a slowing U.S. and some of the developed market economies versus the Asia part, which could benefit from this tailwind. There's some pent-up demand that could be also captured from some of the weakness last year, so lower base effect and some of the revenge spending perhaps coming down the line.
Stephen, on the subject of Indonesia, we've seen foreign investors piling in of late, something to the tune of $4.7 billion since November. What's making Indonesia so appealing right now, and is that a trade you're participating in?
We like the country fundamentals. They've done a lot of excellent structural reforms. We look at the currencies, and it has lagged perhaps other regional ones late last year. There's been a little bit of catch-up so far this year, but we think this is an area where, particular with the weaker dollar, you might start to see some inflows into emerging market local currency funds. And Indonesia is a very significant, at least from the Asia standpoint, that these funds like to allocate into. So bond inflows and perhaps even some equity inflows with IPO pipeline that could also attract more buying of the currency.